Americans live in credit card paradise. Lavish perks for some, long-term debt for others. An 18-year-old can get about $1,000 of credit in minutes from home. Applications hinge on a birthday and social security number. Reported income often rides the honor system. Clicking Pay in Full or Autopay builds prime, sometimes super prime status in months. Now the rewards arrive. Generous cash back on groceries, travel and restaurants. Cashback is typically non-taxable, so headline percentages can feel even bigger. Cards bundle extras, travel insurance, lounges, grocery delivery, streaming, rides and more. Apply strategically and welcome bonuses can reach thousands for some cardholders. But if a giant bank seems generous, look closer. The bill lands somewhere. For every free flight, another cardholder pays 20% interest for years. If high-score users lost banks' money, banks wouldn't hand them premium cards like candy. Great customers exist, but the bigger win is profiting from nearly every transaction. Your bank, the merchant's bank, and a network each take a slice. Those charges are interchange, a fixed fee plus a percentage of the purchase. That fixed piece explains minimums. Tiny buys can get eaten by per-transaction costs. Clue to the size: Home Depot once spent more on these fees than on healthcare. Myth: pay on time and you've outsmarted the system. Reality: they profit anyway. American Express raised interchange, boosted rewards and courted big spenders. More interchange funds better rewards, which attract heavier spenders. Loop complete. Lounges and perks pushed rivals up market. Think premium competitors with hefty annual fees. Huge spending wasn't created by perks. It often reflected who already spends more. High-end credits, like luxury gym perks, signal the audience these cards target. Think of a toll booth between big retailers and high-spending wallets. Issuers are banks. Networks move payments. Some companies do both. Merchants accept networks all or nothing, and surcharges can't vary by card. A few big players refuse certain networks entirely, accepting the trade-offs. Because fees look the same to shoppers, costs get baked into prices for everyone. Results: some households unknowingly pay in. Others withdraw value via rewards. A study estimated cash households lose on average, while card households gain significantly. Lower income shoppers use cards far less. Higher earners put most spending on plastic. Each swipe is a short-term loan. You promise to repay, either now or later, with interest. Average credit card interest hovers around 20%. Missed payments and debt snowballs. If you can't pay by the due date, experts say avoid credit cards altogether. Revolving credit lets balances linger, adding interest on interest over months. Limits depend on income, other debts, and available credit on your other cards. Approval often needs a score built from activity you may not have yet. Simplest path? Get a card, use it, and pay on time. Scores span roughly 300 to 850, shaping limits and loan terms. More than 80% of Americans have at least one card. There are standard, rewards, balance transfer, student, business, secured, and even charge cards. Standard cards come with APRs, annual and late fees, transfer and foreign fees, and rewards. Match cards to habits, groceries, gas, travel, or keep a flat 2% backup. Transferable points open options. Moving points between airlines and hotels adds flexibility. Extended warranties and purchase protection can offset pricey repairs. Americans' favorite reward is simple cash back, especially helpful during inflation. Chasing bonuses can hurt if you constantly open and close cards. Credit history matters. Keep usage near 30% of available credit. Extra cards can lower the ratio. Review accounts monthly. Redeem points early. Programs devalue over time. If you carry debt, prioritize a 0% transfer or the lowest rate. Maybe use cash or debit. The average American holds about 4 credit cards. Organization becomes essential. It began in 1949. A forgotten wallet led to the Diners Club card. Revolutionary then, one card accepted at many businesses. Credit became decentralized. Banks joined in, fronting funds to merchants and flexibility to consumers. Then came revolving balances, slow payback with interest, reshaped attitudes about debt. Early growth had fraud, unsolicited mail-ins, mountains of paper slips, and soaring consumer debt. In 1968, a ruling removed state rate caps. Interest shot higher and stuck. By the late 1980s, credit scores formalized access and baked in biases of the era. Today, the industry is massive. US credit card debt topped $1 trillion by 2023. Rewards can help if you pay in full and pick perks that match your life. Credit cards aren't free money. Understand the system, use it intentionally, and stay in control.